Good morning. This is Larry McMillan with the stock market update on Monday, April 18th, before the market opens. I hope you had a great Easter weekend. So the market has broken down below what we consider to be support at 44.20. It's stayed below there, but it hasn't really accelerated to the downside. So that's modestly bearish. It's not terrible, but the indicators are starting to roll back over to a more negative status. So first of all, the S&P chart, as I just said, has broken that short-term support. The chart itself is in a downtrend. We have the two major peaks that you connect between January and then April, with resistance being about 46.37. There might be some support around 43.20, but the major support area is the February-March lows at 4,100 to 4,200. So the chart is slowly deteriorating, but it's not in a terrible shape at this point. Some of the other indicators, though, are beginning to weaken, one of which is the equity-only put-call ratio. The weighted ratio has now come down a lot from its peak of mid-March and has now generated another sell signal. The standard put-call ratio has not, so it has a little bit negative, but it is not on a sell signal. In addition, the breadth of the market has been pretty bad, except for one very strong day last week. And that one strong day was enough to throw the oscillators back onto buy signals, which are now they're beginning to wane again. So that breadth oscillator has been very back and forth, whipsawy kind of indicator this so far this year. We're not relying on it too heavily right now, but for the record, it is back on a buy signal, and which is beginning to deteriorate. The new highs versus new lows have remained on sell signals. The number of new lows continues to be quite large on most days across all the data sets, New York Stock Exchange, NASDAQ, and stocks only. VIX has been a little bit more positive. We do have the VIX spike peak buy center from a couple of weeks ago, and about a week ago. And the VIX chart is, we're seeing a convergence between the three important indicators, the 200-day, the 20-day, and VIX itself. Right now, those are in a bearish alignment, but it wouldn't take a whole lot to reverse that. So if VIX were to fall below 20, that would be positive for the market. This morning, with the market selling off a little bit, it's at about 24, so that makes it a little bit harder. The construct of volatility derivatives, meaning the slope of the term structure, is positive for stocks. So the volatility complex lines up more or less on the side of the bulls, whereas a lot of the other things are not lining up that way. So we're still maintaining a cautious attitude, and we're trading individual signals as they occur. I invite you to visit our website, where we have newsletters that cover all of these things daily. Meanwhile, have a great week trading.